Imagine holding a banknote in your hand and realizing it represents nothing tangible. No gold in a vault, no silver reserve, no physical object waiting behind it, just ink, paper, and belief. For most of human history, money was real in the most literal sense, heavy, scarce, difficult to create. Gold coins had weight, silver had limits. Even early paper money was a receipt, a claim on something solid stored somewhere safe. If you lost trust in a ruler or an empire, you could still melt the coin and keep its value. But modern money works differently. Today, money is numbers on a screen, endlessly adjustable, infinitely replicable. And here's the paradox. If money is not backed by anything physical, why does it command our time, our labor, and our lives? Why do nations go to war over it? Why do people spend decades chasing it? To understand this, we have to step backward. In the early 20th century, major economies operated under the gold standard. A dollar represented a fixed amount of gold. Governments were constrained. They could not print freely. But wars changed everything. War demanded speed, scale, and spending beyond physical limits. Gold was too slow, too restrictive. So governments borrowed, then they printed. In 1971, the United States quietly ended the final link between money and gold. No announcement to the public, no global vote. From that moment on, money stopped being a claim on something real. It became a promise, backed only by trust in institutions, governments, and stability itself. Modern money is not created by work or production. It is created by debt. When a bank issues a loan, new money appears instantly. Not transferred from someone else, created out of nothing. Every mortgage, every business loan, every credit card balance expands the money supply. Debt and money are born together. Think of the financial system like a massive balloon. Credit is the air pumped inside. Economic growth stretches it outward. As long as confidence holds, the balloon floats higher. Central banks control the pump. Interest rates decide how fast air flows in. Lower rates encourage borrowing. Borrowing creates money. Higher rates slow the expansion. But here's the flaw. Nothing is removed when money is created. The system grows by addition, not substitution. That means yesterday's debt requires tomorrow's expansion. Growth is no longer optional. It is mandatory. The moment expansion slows, stress appears, defaults rise, markets panic. So, central banks step in again. They lower rates, inject liquidity, restore confidence. The system survives not because it is stable, but because belief is continuously reinforced. Money works not because it is scarce, but because everyone agrees to treat it as if it is. Belief becomes the true backing. And belief is psychological, emotional, and fragile. It depends on confidence that tomorrow will resemble today. As long as people trust that their money will buy goods later, the illusion holds. But the system has a limit, not a physical one, a psychological one. History shows us what happens when belief breaks. In Weimar Germany, money printing accelerated to cover war debts and reparations. Prices doubled, then doubled again. Eventually, people were paid twice a day so they could spend their wages before value evaporated. In Zimbabwe, hyperinflation turned trillion-dollar bills into souvenirs. In each case, the collapse did not begin with printing. It began with doubt. Inflation is not simply rising prices. It is confidence leaking out of money. When people realize currency can be created endlessly, they rush to exchange it for real things. Land, food, assets, anything that feels solid. Governments and central banks respond by tightening. They raise interest rates, reduce lending, attempt to restore credibility. But tightening creates pain. Businesses fail. Jobs disappear. Debt becomes heavier. Political pressure rises. So the cycle reverses again. Ease to survive. Tighten to stabilize. Print to avoid collapse. Restrict to regain trust. The system oscillates between fear and stimulus, between restraint and excess. Each cycle leaves behind more debt, more inequality, and more dependence on intervention. The crash is never a single moment. It is a slow realization that money no longer feels safe. And once that realization spreads, no policy can reverse it instantly. Today, global debt exceeds $300 trillion, far more than the world can ever realistically repay. And it will not be repaid, it will be managed. Inflation quietly reduces its burden. Asset prices rise, wages lag behind. Those closest to money creation, banks, institutions, asset holders, benefit first. Those farthest away pay silently through purchasing power loss. Money still functions, but unevenly. And the more it is created, the more fragile belief becomes. This does not mean modern money is fake. It means it is social, psychological, dependent on trust rather than truth. Gold did not require confidence. It required possession. Fiat money requires belief every single day. As long as that belief holds, the system continues. When belief cracks, it resets, sometimes slowly, sometimes violently. The unsettling truth is that modern money is backed by nothing more than collective agreement and institutional credibility. And credibility is not permanent. It must be defended, reinforced, and maintained. So the real question is not whether money is real. The real question is whether trust will last longer than debt. Do you trust money because it is stable, or because everyone else still does?